Good afternoon, and thank you for joining us today. I'm Bruce Tatters, CEO of Red Cloud Securities. Today's webinar features Seabridge Gold, one of the premier gold exploration development companies in the world today, with projects in politically secure regions boasting some of the most significant reserve and resource bases available out there. Today, I have two members of the Seabridge Group, Rudy Franck, co-founder, chairman, and CEO, and Jim Anthony, co-founder and significant shareholder, who will provide both an outlook on the gold market and an update to investors on Seabridge's plans for 2020. After the formal presentation, we'll be taking questions live. Please send us your questions via chat. We'll get to as many as we can. You can type in your questions in the chat box at any time. To start, we'll handle the disclosures and then get right to it. For Seabridge Gold, there may be some forward-looking statements on this call. I direct everybody, when the presentation is up, to direct their attention to page 2 of the corporate presentation, which has all the cautionary notes. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities, or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website, for Seabridge Gold for specific disclosures. So now I'll turn it over to Rudy and Jim to begin. Jim, do you want to begin with the gold part of the presentation?
Yeah, very good. Our objective, our prediction for gold over the next 12 months is a US $2,500 price. We could do better, depending on if the environment is inflationary or deflationary. So I'd like to start there with just a little bit of analysis of that. Gold performs well in both environments. Let's be clear about that. But if you compare the 1970s, an inflationary environment, when gold went from $35 to $850, with the global financial crisis, where gold went from 1,000 to 1921, but by way of 700, and a little bit of an elevator ride down that was scary for a lot of people, you can see that there's a difference in the two environments, often related to where the US dollar is going, up or down. So I'd like to, first of all, review that issue. Now, if you're looking at an inflationary environment, copper and silver perform well. So if you're looking at buying a gold stock, you might consider in an inflationary environment that copper and silver are also going to do well, and that probably is going to help you. And KSM at Seabridge is that sort of project. If you're looking more at a deflationary environment, then maybe the pure gold play is going to outperform. So let's take a look at the two arguments. Let's argue for deflation, first of all. I think Bruce is on this side of the equation. Anyway, recessions are usually deflationary, and you can't argue with the fact that we are in a recession right now. There's high unemployment, and of course that means demand destruction. Fewer people have the money to spend. And we also have debt defaults, which support a scramble for cash, a stronger US dollar, which is not a good thing usually for gold. But I would note that the dollar has weakened recently, even though inflation expectations are at all-time lows. And of course, businesses slash prices in order to make sales. That's deflationary. And you can see in the last 3 months that wholesale prices in the US economy have been falling. All right, let's look at the other side, inflation, which is really an argument for don't fight the Fed, because the Fed is very interested in having some more inflation, not only to meet their objectives of 2% or better, but also because they'd rather have the economy run hot, as they say, and they would like to, over time, devalue the enormous debt load on the economy. So they're going about things very differently this time from the QE era. Treasury is boosting demand by sending checks directly to individuals, and therefore, in fact, consumer spending is much stronger at this stage of this very deep recession than you would expect. The Fed is also preventing defaults, cutting rates, buying corporate debt, even high yield debt, and lending to businesses by way of Treasury special purpose vehicles. These ugly new creations that Jay Powell and Mr. Mnuchin have collaborated on. So this is not at all like the 2008-2014 stimulus by way of quantitative easing. And therefore, you shouldn't be looking for the same non-inflationary results. The supply chain is being disrupted severely. People are moving their production out of China, especially. They're redistributing it around the world. This is a major problem in terms of cost controls. It's a major problem in terms of maintaining levels of production because just one little part missing from one little factory somewhere else causes the problem. We see this as inflationary. And we're also concerned about foreign confidence in the dollar. Now, foreigners own $25 trillion worth of US assets and currency. So what they think really matters. And an out of control federal deficit, surely we can agree to that. It's running at $3.6 trillion for the year ending this September. And the upcoming election of the century would likely, and in our view, damage foreign confidence in the dollar. That brings the dollar down. That increases inflation. And finally, and perhaps most importantly from our point of view, money supply is growing at an unprecedented rate. Back in the QE era, the last stimulus era following the Great Depression, the Great Recession, money supply at its peak was around 7% year over year. Today is another story. This is absolutely amazing. We have year over year money supply growing at the rate of greater than 30%. If you just look at the last 6 months, it's 106%. This is amazing. And we think ultimately very inflationary. Now, can the Fed create inflation? They've failed, after all, for nearly 10 years. We think the answer is yes. You can see stagflation coming. That's what we're expecting, which would support a huge move in gold, similar to the 1970s. The value of the dollar and other fiat currencies would be crushed. It's worth noting that the dollar fell 96% against gold in the 1970s. We think potentially we're headed back to that type of environment. Key rules have been changed. So again, this is not like 2008. By the way, my slide says the Dodd-Frank legislation, it should be Dodd after Senator Dodd. But the real economy is now getting the money, not the financial system. In 2008, we had a wonderful innovation, actually it was early 2009, called interest on excess reserves. This was implemented by the Fed so that it could capture the money that it created through its QE programs. So it would buy assets, the assets would go to the banks and go into their reserves, where in fact it was like having a corral on Wall Street where the money never left and was available for the purchase of securities. The new stimulus is not at all like that. So calling it the new QE is in fact very misleading. It's misleading in type, as we just described. It's misleading in amount too, because the last time around, the total build in the stimulus program was $3.5 trillion, all added to the balance sheet. This time around, it's $6 trillion, so more, but in much less time. So the speed is different and the nature is different. This time around, the 6 trillion consists of 2 trillion approved by Congress to be spent by the Treasury. 1.5 trillion of that goes directly to individuals and businesses, which we think is inflationary. And the other almost $500 billion is used to anchor the special purpose vehicles which have been created, which will nominally be operated by the Treasury, but one suspects by the White House. And this money is used, that little less, 454 billion to be exact, is used to anchor a $4 trillion line of credit, in effect, from the Fed. So in all, $6 trillion. And it's interesting to note that the program for the Great Recession implemented by the Federal Reserve over the 2008-2009 period actually took 18 months to fully flesh out and implement. This program, which is increasingly innovative and much more, was fully implemented in 8 days. Amazing stuff. So the Treasury is borrowing from the Fed to pay people not to work and businesses not to produce. This is true debasement of the currency. It's not credit inflation as we had in the QE era. And just to top that off, a wonderful statistic, 59% of all the money spent by the federal government this year will be derived from new debt, not from taxation. 59%. One final argument that we think is going to drive gold, the gold price. It's an old argument that probably no one thinks about anymore, but we think will become relevant over the next couple of years. The Fed balance sheet is degenerating rapidly. Rudy and I call it a payday lender now, but with no payday. And yes, we think the quality of its balance sheet may matter as much as the quantity. And let's talk about that. Let's talk about the Fed balance sheet. We'll call it the good, the bad, and the ugly. Now, we all know the Fed buys assets and issues liabilities. Its liabilities are dollars. In the beginning, which sounds biblical, but it actually only goes back to 1914, the Fed owned gold and 90-day commercial bills used to finance trade, and the liabilities, that is the dollars, were as good as gold. Over time, the balance sheet has changed a lot. First came a massive increase in government bonds to the point where it became the dominant asset. And then after 2008, these bonds were joined by huge amounts of mortgage-backed security. We think of this as a significant weakening of the balance sheet, and not surprisingly, the dollar, the liabilities issued by the Fed went down in value correspondingly with a lag. The balance sheet is now adding corporate debt, including high yield debt and municipal debt. Wow. Are write-downs coming? We think so. How will the market respond to this? Well, we'll see. But our view, and you can show this historically, is that every weakening of the asset mix has led to a weakening of the liabilities, the dollar, with a lag. So with that, our justification for why we see $2,500 plus over the next 12 months, I turn it back to Bruce.
Thanks for that, Jim. You asked me about whether my prevailing view was deflation, and it's not this is your guys' webinar, so it's not my job to prognosticate too long. But I would tell you that from my standpoint and some of the very brilliant people that I get to read every day, this COVID is probably one of the most perfectly created deflationary forces in just about and not even in modern history, in history, creating something that has forced people to stop economic activity. So I think to your point, the deflationary headwinds coming at the system right now probably there's never been a precedent for it. And unfortunately, the only counterbalance is the printing press for both the government and its Federal Reserve Bank to create the money out of thin air that they're shoving out to everybody. And there's got to be a reckoning at some point when people, whether it's the Fed who ends up creating too much money out of thin air, or whether it's government debt that has no possibility of paying it back or potentially even carrying the cost of the interest as it grows at the rate it's growing now. There's really it's difficult to have a conclusion that the US dollar is not, and to be honest, all the other Group 7 countries are in similar conditions. Yep. So it's going to be a debasement against real assets. Buffett always used to say, you really think your house is going up 8% a year? It's the purchasing power of your money that's dropping each and every year. It's really that simple. And those hard assets in the world, they become very precious when everything else is being debased at the rate it is. So anyway, that's my 3-minute plug. Sorry, Rudy.
No problem, Bruce. As you know, your comments are always welcome. We've known each other a long, long time.
So listen. Jim, go ahead, Rudy. No, go ahead.
Jim, thanks for that. Obviously, you and I worked together now for well over 20 years, and it's been a pleasure working with you. And your views on gold over the past 20 plus year have been outstanding. And as a result of that, I think you and I were able to create what has become the best way to play higher gold prices.
Yep.
And hopefully, as I walk you through the presentation today on the Seabridge side, you'll be convinced that if you do believe in higher gold prices, or if you at least want to have some exposure to higher gold prices, that Seabridge is probably one of the better ways to play that.
I would mention too, Rudy, just to give Jim a bit of credit, since the affiliation with Red Cloud and Seabridge over the last few years, I would tell you our retail group that manages all of the high net worth and family office people and retail brokers around North America and Europe, it's remarkable the following that you've gotten, Jim.
Good.
Not to Rudy's detriment, but they certainly enjoy having you as part of the presentation and listening to your thoughts. Did you want to take, so my question is, as the questions are starting to come in on the first section, do you want me to leave those till the end, Rudy? You do your presentation, or do you want to talk about any macro stuff in questions now?
No, I think why don't we go ahead with the rest of the presentation? Then Jim and I are happy to stick around as long as necessary to answer questions.
Fantastic. I love that. So
if people need to leave before that, you can always forward questions on to Jim and I by email, and we'd be happy to respond outside of this presentation as well.
Terrific. Well, on that, I'm gonna mute myself again and let you begin on Seabridge, Rudy.
Okay, thanks, Bruce. So the case for Seabridge, I think it's pretty straightforward. We have lots of metal in the ground, both in terms of gold and copper. In fact, between KSM and Courageous Lake, we have over 45 million ounces of proven and probable gold reserves and over 10 billion pounds of copper. And that's contained within an overall mineral resource of 123 million ounces of gold and 46 billion pounds of copper. I think what we're proud of the most at Seabridge is that over a 21-year history now, we only have 66 million shares outstanding. People look at our share price and say, wow, at $25 Canadian or $18 US per share, you're expensive. But when you take into account the metal we have and the low share count, we actually are relatively cheap. In fact, today we're trading at only $25 per reserve ounce, or on a total gold resource basis, less than $10 per gold resource. Jim and I have built mines in our careers together in third world countries that were expropriated. Political risk is very real in our space. When Jim and I formed Seabridge in 1999, the concept was to minimize political risk by focusing only on North America. Today, all of our reserves are located in Canada. And not only that, our KSM asset, which is the core asset in the company right now, has now successfully completed the environmental assessment process, again, minimizing risk. I think what our team has done best, though, is finding gold. Over the past 15 years, our exploration team, led by Bill Threlkeld, has found more gold than any other company on the planet. And yes, that includes Newmont's, Barrick's, Kinross's, who spend hundreds of millions of dollars a year in exploration, but don't come close to us in terms of delivering discoveries. We also take advantage of downturns in the market. When we formed Seabridge in 1999, the price of gold was very low. We did our first wave of acquisitions from 1999 to 2002 before the gold price moved. Over the past several years, after gold peaked in 2011, we had a big downward trend in gold and gold equities, and that created another environment for us to go out and start acquisitions. And since that time, we've now completed 3 acquisitions, new ones that I'll touch on during the presentation. This is a slide I guarantee you will not see another gold company show you. When we formed Seabridge, our objective was to create the best leverage play to a rising gold price. And the simple formula that we have followed now for 21 years is making sure that ounces in the ground grow faster than shares outstanding. It always amazes me to look at exploration companies that already have hundreds of millions of shares outstanding, yet no resources or reserves. Everything we do is to grow ounces on a per share basis. And if you look at our track record over the past 20 years now, we've really delivered on that. In fact, by the end of 2019, with 62 million shares outstanding and 123 million ounces in the ground, it meant that each one of our shares was backed by about 2 ounces of gold per common share. Nobody in the industry comes close to that. In fact, we provide 10 to 20 times more gold ownership per share than anybody out there. And what this has translated into is what we were designed for, and that's outperformance, optionality, and leverage to the gold price. If you look at our share price relative to the gold price or relative to other gold equities, over the past 21 years, we have outperformed the gold price on an average of 10 to 1, meaning that every 10% increase in the gold price has essentially led to a 100% increase in our share price. Gold is up just shy of 500%. Our shares are up over 5,000%. And then if you look at those periods of time when gold is in a really bull move, that's really when our shares shine. We believe that started again here recently at the bottom of COVID when gold hit about 1,500. It's now at 1,800. Gold is up about 20%. Our share price bottomed at COVID at about $5.25 US. It's now through $18 a share. Our 2 prior peaks of $39 a share in 2007 and then again in 2010, that has been the high watermark to date. However, I will point out that back then we had no reserves, we didn't have an approved project, and we think that the price of gold is going a lot higher. And today we have a lot more ounces of gold per common share. So we believe the best is yet to come, and we believe that if you're looking for a way to play the gold market, Seabridge has a 21-year track record of successfully outperforming gold and other gold equities. So what I'll touch on in the limited time we have left here today in the presentation is really what's new at KSM, or what's new at Seabridge. First and foremost is the updated study we just filed for KSM, which shows a much improved project design as well as much better economics. I'll also touch on our recent acquisition. We just recently completed an acquisition of a new exploration project called 3 Aces located in the Yukon, and also talk today about the drill programs that are now getting underway at both our Iskut property and at Snowstorm in Nevada. KSM is a project we acquired in June of 2000. We paid $200,000 for this project back then when gold was trading at about $260 an ounce and copper was trading at about 60 cents a pound. If you fast forward to today, we've now spent $300 million at KSM, defining today what is the world's largest undeveloped gold-copper project as measured by gold reserves. We've also taken this project beyond just exploration and engineering, and we now have permits in hand to start construction here. And to get to the point where we are today, we also made a lot of effort and spent a lot of time on building our social license with the indigenous groups and local population centers around that. In fact, today we have fully signed impact benefit agreements with the Niska and the Tahltan Nation. I think what's best, though, is what has been done with other people's money. When we bought this project in June of 2000, there were no highways, there was no power, there were no ports. If you fast forward to today, we now have a major highway just to the east of KSM, Highway 37. Along that highway is the governments of Canada and British Columbia have spent over $700 million extending the power grid, providing very, very cheap power to the area. We've now secured, with contracts with BC Hydro, 250 megawatts from that line that we'll be able to buy for US 5 cents per kilowatt hour, some of the cheapest power in the world. And last but not least, just to the south of us in the town of Stewart, we now have 2 new active ports, which will provide us access to bring supplies in on an annual basis and concentrate out to any smelter on the Pacific Rim. I can't tell you how important having access to roads, cheap power, and ports are compared to other large undeveloped projects around the world, especially because they've been spent and paid for by somebody else. We finished a pre-feasibility study in 2012 that was used as the basis to apply for our environmental approvals. We did receive our environmental approvals in 2014. In 2016, we elected to update the pre-feasibility study to show the impact of the commitments we made during the environmental assessment process on the project's economics, as well as to take into account the changing metal prices that happened and the changing exchange rates from 2012 to 2016. In that updated pre-feasibility study, our mine plan captured 2.2 billion tons of ore, containing 38.8 million ounces of gold and just over 10 billion pounds of copper. And this mine plan, which we call our reserve mine plan or our PFS mine plan, had an all-in cost of production, which included all of the upfront capital, all of the sustaining capital over a 50-year mine life, all of the closure and reclamation costs, and all of the operating costs net of copper and silver credits of only $670 per ounce of gold produced. So at today's gold price, you're looking at a margin better than $1,000 an ounce on 38.8 million ounces. As good as that study was, it gets better. We have now added 2 new zones to the project. First, the Deep Kerr zone, which is a 2 billion ton deposit we now have with much better copper grades than we've seen heretofore. And then more recently, the Iron Cap zone with another 2 billion tons of material at good gold and copper grades, well above our copper reserve grade. In the 2016 PFS, we actually showed an alternate mine plan that captured the Deep Kerr zone, showing an improvement in the project's economics going from $670 an ounce all-in cost down to about $350. Earlier this year, actually just within the last 2 months, we filed a new mine plan that takes into account not only Deep Kerr, but also the Iron Cap deposit. We are blessed with 4 deposits that now give us 7.6 billion tons of economic resources that are constrained by either block cave shapes or open pit shapes. These 7.6 billion tons of resources capture about 107 million ounces of gold and 46 billion pounds of copper. As we went through the environmental assessment process, we received approvals and permits for a tailings facility that can hold about 2.4 billion tons of tailings. So although we have 7.6 billion tons of economic resources, we've been focusing now is what is the best 2.4 billion tons that we're permitted for that can be mined to drive the best project and drive the best project's economics. Our most recent mine plan that was just filed now sequentially mines the 4 deposits. First, Mitchell Pit is a big open pit that gives us at least 15 years of open pit material to mine. Then Iron Cap comes in within that time period as a block cave. And then Kerr, both an open pit and a block cave. And then finally Sulphurets. And if you look at the updated mine plan and think about the comparison to the reserve mine plan, again, capturing 2.4 billion tons of material and limiting our mine plan to what's approved on tailings capacity, we now show a mine plan that captures just over 40 million ounces of gold compared to the 38.8 million ounces we have in the reserve mine plan. But instead of 10.2 billion pounds of copper, this new mine plan, because of the higher grade copper at both Kerr and Iron Cap, now captures 19.2 billion pounds. So another 9 billion pounds of copper that comes into the mine plan at essentially the same throughput. At 170,000 tons of ore throughput a day, this will be the largest mine ever built in Canada. We are fortunate that even with only limiting our mine plan to to the 2.4 billion tons of tailings capacity we have permitted, we still can show a mine plan in excess of 40 years, capturing a lot of metal, both gold and copper, on an annual basis. Shareholders over time have asked, well, why do you keep doing this work if the PFS in 2016 was so good anyway? Well, I think it's important to point out that our goal at KSM is to bring a joint venture partner in. The better project we can show from an economic and capital efficiency standpoint should help us in our dealings in a joint venture discussion. So if you look at the 3 mine plans now side by side, using the same metal prices that were used in the 2016 studies of $1,230 gold and $275 copper, you can see how this project has improved over time. The all-in cost of production dropping from $670 down to $350 with only Deep Kerr, and now down to below $100 an ounce, including iron cap. Those metal prices are no longer applicable. The SEC asks that companies use a 3-year metal price average in terms of their mine planning. So what we now have is our 2020 PEA base case uses $1,340 gold, $280 copper, and a 0.76 exchange rate. And I might point out that metal prices are much higher than that now already in terms of gold and copper and silver, and the exchange rate is actually lower. But even with that, looking at the 2020 PEA base case, we can now show a project that essentially produces the gold for free. What that means is we're now producing enough copper in terms of revenues to offset all of the capital costs, all of the sustaining capital over the project life, all of the reclamation costs, all of the operating costs net for the project. So we now can report an all-in cost of production, including everything, of only $4 per ounce. And then obviously, as you play with higher metal prices, you can see the optionality and the leverage that this project still has to higher metal prices. I've been in the business for over 30 years. I've yet to see a project with this type of capital efficiency, not only in terms of net present values and internal rates of returns on a project that goes on for 40 plus years, but in terms of payback period relative to mine life. This is an important measure for capital efficiency. How quickly do you get your money back on your initial investment relative to how many years you have left in the project? And in our case here, we're recapturing all of the upfront capital in less than 4 years, and if you use today's metal prices, in less than 3 years on a project that goes on for more than 40 years. And again, that's only capturing a third of the resource. The project will actually go on for more than 100 years at that production rate. And then the after-tax numbers taking into account a worst-case tax scenario where the company that owns this project has nothing else to write off against it, which obviously will never be the case. We're not a single asset company. We also have another large project in the Northwest Territories called Courageous Lake that we acquired from Newmont and Total in 2002. We did a lot of work at Courageous Lake before we did any work at KSM. And by 2012, we actually completed our first pre-feasibility study on this that showed a project that was fairly marginal back then at the then metal prices and the exchange rates, but had exceptional leverage to the gold price. If you look at the economics of the 2012 PFS at Courageous Lake, you see what marginal means. A payback period of 11 years on a mine life of only 15 years. Obviously, nobody's going to build that mine, which is why we then really started to focus more on the opportunity at KSM as we made huge discoveries there. But if you look at Courageous Lake at today's metal prices and today's exchange rate, what was a marginal project back in 2012 looks a lot better today. And then on top of that, last year we did 2 internal studies using independent consultants to look at Courageous Lake and rethink, is there a smaller, more robust, better economic return project here than what we have in our PFS? And it came to the fact that there actually is. We're now looking at Courageous Lake and what is the best way to drive value to our shareholders going forward. We are considering an outright sale of this asset, looking at what other metrics have been done here on similar size assets. This asset should generate several $100 million to us if we choose to sell it, or perhaps through a joint venture with a partner that wants to spend the dollars. So stay tuned on this. We are going to be looking at what is the best way forward on Courageous Lake to drive value to our shareholders. we do best at exploration, and we now have 3 new projects to play with on the exploration side. The most recent acquisition was 3 Aces that we acquired from Golden Predator, a large land package that's situated in the Yukon. To buy this, we paid 300,000 shares and issued Golden Predator a 0.5% royalty on this asset. And then also we agreed that if we are successful at 3 Aces with our exploration activities, that we would make further conditional payments to them in cash based on the level of ounces that we find. Believe me when I tell you that we hope we have to make these payments, because that means that we have had the success we were hoping for at 3 Aces. If you look at it on a map, it's located in southeastern Yukon, just above the border with British Columbia. It really is a district. It's not a project. We control over 350 square kilometers in the claim group of 35 kilometers of strike length that has high-grade gold showings up and down the entire length. We also have year-round access to this. Our other projects are fly in and fly out. This is a project that we have a road right to the front door of the asset, as well as an exploration camp. What intrigues us on this, clearly, if you look at the drilling that's been done here historically by Predator Gold, they were very successful in terms of finding very, very high-grade gold at or near surface at mineable widths. You look at some of these numbers here, and numbers jump out at you in terms of 0.5 ounce to 1 ounce to multi-ounce per ton material right at the surface. Further opportunity that we see above and beyond the vein material that has the high grade at the surface and perhaps likes to it is that outside of the vein material is also evidence of a fair bit of gold mineralization that obviously is not the same grades as the veins, but could lead to a bulk mineable potential at 3 Aces. We are now in the process of assembling all the data that's been collected here historically, working it into a usable 3D database. We plan to get up to site this summer to do some mapping, some sampling, and some more geophysics, with the hope that we'll have our first drill program ready to go at 3 Aces in 2021. We see the potential here of 5 to 10 million ounces of a higher grade system than anything we have to date in our portfolio. Another project that we're now taking to the next stage is the Iskut property, a project that we acquired when we bought Snip Gold, a publicly traded company on the Vancouver Stock Exchange, for 700,000 shares in June of 2016. We see a lot of similarities to Iskut as we now have at KSM. We're dealing with the same style of mineralization, the same age of mineralization, the same rocks, and the same structural controls that led to our 4 large deposits at KSM. Over the past few years, we were kind of getting our arms around this asset. What are the best opportunities for us to focus on for a larger drilling program? We first started looking at this lithocap concept, very similar to what Pretium has on their side of the border at KSM, looking for higher grade, near surface vein type material. What we found, though, was that although there is evidence of high grade there in terms of some of the sampling we did, most of that lithocap has been eroded away, which led us to actually finding a diatreme there 2 years ago, which leads us to believe that we're now fairly close to a potential copper gold porphyry system. Last year we did a bunch of geophysics, which has been very successful at KSM in terms of highlighting porphyry targets. We have a big whopper of a target to go after, and within the next week or so we should start our first drill program here at the Iskut property, focusing on KSM style mineralization. And the drilling will start on the backside of this mountain, where we believe that we have easy reach down to this porphyry target. The third exploration project we have in the portfolio now is that Snowstorm, a project we acquired in 2017 from John Paulson and Company from New York. We issued John 700,000 common shares and some purchase warrants. We bought this project not obviously it doesn't have any existing resources, but if you look at the address here of this project, it sits right on the intersection of the 3 most prolific gold belts in Nevada: the Getchell Trend, the Northern Nevada Rift Trend, and the Carlin Trend. In fact, just to the south of us on the Getchell Trend, you have 2 of the most important mines in the new Newmont-Barrick Nevada joint venture. Our focus here is to look for Twin Creeks Turquoise Ridge style mineralization. Last year we did our first drill program at Snowstorm. which confirmed that we had the right rocks, the right structural elements, and the right alteration. This year, we hope to vector in with a larger program to try to get closer to where these high-grade zones may be. The drilling program here should start within the next 60 days. So if you're looking at owning shares of Seabridge, how are we going to drive value for you? Well, clearly, I think we already demonstrated that if the gold price is going higher, so is our share price. We have a 21-year track record of outperforming gold. If gold does what Jim and I think it's going to do, going to not only new highs, but to levels that surprise a lot of people, our share price will go on fire. And then exploration success. Our team has found more gold than anyone else in the past 15 years. We now have 3 brand new projects to play with, any one of which we believe could be a company maker. And then finally, a joint venture. I know we've been talking about a joint venture at KSM for some time now. We came to the conclusion very early on that KSM, because of its scale and complexity, will require a major mining company as our partner to co-develop it. Our goal in a joint venture is to hang on to a meaningful interest in the project while minimizing our capital contribution. In our view, there's probably 7 companies at most that have the technical, financial, and social wherewithal to develop and build KSM, and that's where our dialogue is focusing. We have turned down proposals in the past from several of these companies, and that they didn't meet the objectives we were looking for in a joint venture. We only get to do this once, and I think at the end of the day, our shareholders' patience in terms of working towards this joint venture will be rewarded. There's no doubt in my mind that when you look at the major mining companies today on both the gold company side and the copper side, the elephant in the room that nobody is really starting to talk about yet is that most of these companies only have reserve lives of 10 years or less. They need new projects. They're going to be focusing on projects of scale, that have good capital efficiency, and are in safe jurisdictions and are permitted. KSM is the only one that I can think of out there today of size that checks all of those boxes. Last slide before we turn to questions. We are dual listed, although we are a Canadian company. Most of our trading activity is on the New York Stock Exchange. We are included in a number of the key indices, both in the US and Canada. Low share count, no debt, decent balance sheet. We now have working capital in excess of $40 million on our balance sheet. And then I think another differentiation between ourselves and other peer group companies is if you look at the insider ownership structure of Seabridge. Insiders of this company, including myself, Jim Anthony, and Albert Friedberg of FCMI, and others, control nearly 40% of the outstanding shares of this company. That is remarkable considering that it's now 21 years old. And then finally, we also have strong financial institutional support as well in the United States and Canada. So Bruce, that's it for me. So happy now to move to the Q&A part.
Terrific, Rudy. Thank you for that. Jim, if you're on the line too, I'm going to sort of go back and forth a little bit, so we have a bit of diversity in some of the questions.
Yep.
One of the first questions on the macro side, Jim, came in. Do you anticipate the U.S. federal election in the fall having a potential impact on the U.S. dollar? There's been others out there that have indicated both the nature of the U.S. election having to be a sort of a electronic type of election where people may not even go and vote, and the candidates in question who are running may make it quite an interesting electoral season. Any thoughts?
Yes. Rudy and I do try to remain neutral in our political views. And in fact, I wouldn't know which of the 2 candidates I would vote for at this point. I don't think either would necessarily get my vote. I think the concern here is that there is no agreement covering the period end of September through to the election. The checks stop. Will there be agreement between the parties that will allow the stimulus to continue? Because I think that the economy and the people of the United States are going to need it. 28 million people have now defaulted on their rent. 28 million. What's going to be done about that? I don't think we're going to get agreement. What I think we're going to get is a lot of posturing and a lot of disagreement and a failure to come up with another stimulus program. And I think this is going to cause an immense amount of heartache, chaos, and finger pointing. Beyond that, I can't see. I don't know who's going to win this, or in fact, is Joe Biden actually a presidential candidate, or is he simply hiding in the basement? Will there be a vice president who takes over and actually provides the sort of direction that the party and the government would need? I don't know. I think it's the confusion and the uncertainty that will have an impact on the dollar, and the fact that I don't think there'll be an agreement to provide a further stimulus package before the election.
Okay, not to jump back and forth too much, but let me just stay with Jim then for 1 second. One of the other questions that's come in here is, if you're in a situation, the question goes on, if you're in a situation where many countries in the world have similar, they may not have electoral challenges, but they might have similar fiscal and other debt problems, what ends up happening? I know we talked a little bit about the hard asset concept, but maybe you want to answer that directly, Jim. What happens if the US isn't the only bad neighborhood, that all the neighborhoods end up being bad? What happens out there?
I think you get an incredible scramble for gold. I would like to think there is an alternate currency that I would jump to. I have a dear friend in Switzerland who is trying to persuade me that the Swiss franc is an alternate route to safety. I don't believe him. The Swiss National Bank is the world's largest hedge fund.
Correct.
It owns more Apple than any other U.S. institution. So no, I don't think.
Which hasn't been a bad investment, I might add.
Yeah,
up until now.
Not up till now. No,
not up till now.
Very good.
But it's also hard to see with the enormous amount of U.S. dollars being used as the reserve currency, how a currency like the Swiss franc could possibly.
There isn't room.
There isn't room.
No.
Right?
Yeah.
I mean,
China is going to make a bid to be the next reserve currency. And I think that the Fed policies are so extreme that they are going to bring the US dollar as a reserve currency into question. It will be a question then of how much gold and other real assets China has. It's very hard to believe any of their statistics on anything from deaths by virus through to electrical consumption or the GDP number. But there are some people out there who can provide relatively believable statistics that Chinese gold ownership is way larger than is advertised, that they have been slowly accumulating outside the official reserves of the People's Bank of China for the last 25 years, and that they are ready to make a move on the reserve currency issue if it comes to that. We'll have to see. I don't make a prediction there, but I know that they have that interest in displacing the U.S. dollar as the most viable reserve currency.
Okay, I'm going to move on to Rudy to give him a chance to talk. And we'll jump back a little bit, but back and forth. Rudy, the first one is one of the ones I just got is, what impact on the share price will occur with a partner at KSM, and will this lead to dividends?
I believe it'll have a huge positive impact on our share price. The best comp company today to Seabridge is Nova Gold. They have a large asset in Alaska that'll require more capital than what KSM will. The operating costs and total costs will be $1,000 higher per ounce than what we have based on our study and the studies they put forward. But because they have a joint venture partner in place with Barrick, moving the project forward towards a construction decision, although they're not fully permitted yet, they trade at 5 to 6 times our valuation, maybe a little bit less now. They have come down recently. but just an indication in terms of where our stock could go with the right partner in place and the right terms. And then on top of that, we also have one of the largest short positions in the industry, relative to our float. I think right now it's probably almost 20% of our float is short. I believe with the argument of those shorts, although I don't know specifically who they are, the argument I've heard from time to time is we've talked about a joint venture for some time. It hasn't happened, therefore it's not going to happen. I believe that on top of just the recognition we get from a partnership with new investors coming in to buy the stock, we'll also see a pretty quick short covering rally here that'll take the stock even higher. So I'm pretty positive in terms of what happens to our share price with the joint venture.
Rudy, another question is you did mention that one of the reasons that it's taken a while on KSM was that there's really only 7 major companies out in the world that can take on this thing. So the market knows you've been talking for a while with these large parties. Has there been any discernible change more recently in their posture given the commodity environment we now find ourselves in? Like, we've got copper at $3 here, gold at $1,800, silver breaching $19 an ounce. I realize it's not as big as the copper gold at KSM, but have we seen any discernible change in the profile or posturing of the large guys out there?
Yeah, no question, Bruce. It's not just the metal prices, which helps our dialogue with terms and partnerships, but it's also the need now of the big companies for new projects. If you look at when we started to bring forward the concept of a joint venture at KSM, it was in 2012, 2013, even 14, where we really started that. After gold made its peak in 2011, gold then dropped from 1,900 down to 1,050. At the prior peak, these big companies blew their brains out on acquisitions, overpaying, and taking on so much debt that when the gold bottomed at at 1,050 in 2015, all they started to do was focusing on selling non-core assets to pay down debt. They weren't really focusing on new opportunities. And also during that time, they did very little exploration in terms of finding new projects or finding new reserves. So as a result, they weren't focusing on new opportunities like KSM, and that's kind of when we started to bring the concept forward. But now if you look at them, yeah, they have done a decent job of cleaning up their balance sheets, selling non-core assets, paying down debt. And now the cupboard is bare because they did very little activity during the past decade in terms of exploration activities or new acquisitions. They now have to start focusing on new projects. So I like the environment we're in now. As I said, we are going to be very patient on this. We are not going to force a deal just for the sake of getting one done. If we had taken that position, we would have done one of the deals that was offered to us in the past. We only get to do this once, and believe me that when we announce our deal, it's going to be on terms that I think will make all of our shareholders happy.
I mean, one of the other questions here, Rudy, is also that KSM's in a wonderful spot where it's had its permitting and it's had its native relations and all of the things put into place. Some of the other potential large ore bodies out there, they might be years, even if someone who was to make one of these types of acquisitions, like you say, as the cycle gets better here, it might be a while till we really see any of these other ones in production of any magnitude. So the cupboard's very bare, and there wasn't a lot of it might take a while to fill it again. Is sort of what this question's asking.
Yeah, no, you're absolutely right. If you look, I just look at my career. I've been in the business now for I think 40 years actually this year, and back then when I started, you can get a mine found, engineered, and permitted in a couple of years. If you look today though at the environment, I think BMO did a study on this recently that from discovery to first production on a large project, it's now more than 20 years. So it takes a long time, not only to find it and engineer it, but then it takes a really long time to permit it. And I think that's a de-risking that will really help us and is helping us in our joint venture discussions, because the other opportunities out there still have a long way to go before they actually can start construction. We are now shovel ready at KSM, and work can begin there tomorrow if we would choose to.
I'll just throw one more in on the KSM before we move on. With the increasing copper price, will the increase in copper price now lead to a partner, or what copper price do we need to potentially entice a partner?
Copper price is important. There's no question about that. At $3 copper, obviously this project sings. I've always thought that $3 and above is probably the environment we need to get the terms we want, and we're now close to achieving that. The question is now, how long will copper stay there, and will the companies that we may choose to partner with are comfortable that copper at $3 is here to stay? But I like our chances much better at $3 copper than I did at $2.15 copper.
Okay. Jim, back to you. I hate to jump back and forth, but I think this makes it fun. I remember recently having a conversation with somebody who I think is a great man in the mining space, Eric Sprott. And we were talking about what had happened in the oil market, with the fact that with the demand cuts that had happened globally, the oil market actually found itself in a position where storages globally were filled. The floating storages were filled, and we actually saw the contract trade to zero. And Eric said something very interesting to me, both about gold and silver. He said he envisions an environment where we might find ourselves in the absolute reverse situation, where there might be a demand for physical gold out there, and we might end up in a vertical move because there will not be the absolute physical gold that might be required to satisfy, the contract market that may erupt for gold. Do you have any thoughts on that?
Yes, it's a possibility. Now, it is worth remembering that we have about 5.8 billion ounces of gold above ground. So there is a fair bit of the metal around, and a shortage is not going to happen ever, provided the price is sufficient to induce selling. Now, that's where there could, to follow your logic, if you were to have that straight up shot, which Eric is calling for, or thinks may be possible, you have to have something extra in the mix. And I think there is something extra the gold market is wonderfully opaque. We know very little about it, and that's by design. It's always been a way for very wealthy people to keep a significant asset position outside of public view. But here's where the problem could occur, and it's in London. The London Bullion Exchange has bullion banks that have handed out all kinds of chits that say that you are entitled to X number of ounces of gold. You make a deposit there, you get a chit. Or you put up money, you get a chit. Have you allocated that gold? Well, no. It appears that something like 95% of all the gold held in London by individuals and some institutions is not allocated. Now, this does not apply to GLD and other ETFs. They do allocate the gold, but mostly it's not. And it's not for a reason. It's expensive to allocate it. It's expensive to have your own little pile of gold in someone else's warehouse with your name on it that is not liable to any of the other issues that the institution holding it may undergo. It's yours outright. Otherwise, it's actually a liability of the bank. So what are we going to see if the gold, physical gold, becomes extremely sought after and people turn up with their little chits and would like their gold? They're going to find that there isn't any for them. And most of these accounts do have a force majeure out that allows the bank to settle in dollars. But dollars are not gold. So I think there is the possibility that there will be a discontinuity event that drives a vertical lift in the gold price. That if there is one out there, I think that's it. It's not the paper market in New York. It's not COMEX, because people don't go there to buy physical gold. They go there to speculate in gold in dollars and take their profit in dollars. The people you have to watch for are the ones who really think they own gold and have it quietly put away in a very good name brand bank, and it's really not there for them when they ask for it. That's possible. You know, these chits, as I call them, have been issued for the last several hundred years, and there hasn't been a run on that bank, on any of the banks for gold. It is, in fact, fractional banking, not in dollars, but in gold. That is a potential explosion at some point. I would not care to guess when that might be.
Okay. Next question, we'll go back over to Rudy. Are potential partners wanting to buy Seabridge instead of JVing a project?
Look, at the right price, everything is for sale. What I will tell you is that you're looking at two of the biggest shareholders here right now on the screen. You throw in Albert Friedberg on top of that. Between the three of us, we control probably pushing 30% of the company. What I will tell you is that today's share price plus an ordinary premium would not get a deal done. When I look at our asset base today and say, okay, we're trading at $25 per reserve ounce on ounces that mostly come out at zero cash costs. At $100 an ounce, which I think is more like what the industry actually trades gold reserves at today, our share price is north of $70 US. At those levels, yeah, there might be interest on our side, but at today's share price plus a 20 or 30% premium or even a 50% premium, what do you say, Jim? You're a seller?
Nope, not at all. And I love our exploration plays.
Yeah, and I think the big players know that. They see the share structure of this company. It's part of their due diligence in the data room and the CAs they sign. They have access to all that information. They know that what our intent is here is to get a joint venture done, not sell the company. But at the right price, Bruce, of course. Is today's share price the right price? Not even close.
Absolutely not.
And besides, Rudy, this is too much fun. We're still having fun. Why sell?
So
Absolutely.
just a little history here, a little fun since I have Jim here. When Jim and I started Seabridge in 1999, we had what we called the rule of fives. Our goal was, and we took over a shell that had a 15-cent share price at the time. Our goal was 5 years, $500 gold, 5 million ounces, and a $5 share price. Okay? Mm-hmm. Here we are, year 21. We have 123 million ounces of gold. Gold is at $1,800 an ounce, and our share price is only at 18.
And
one thing is not right yet.
One of them is not marked to market properly.
Yeah, it's an unfinished project.
Exactly.
And listen, a question on one of the things you just mentioned in your last to Jim's point, of your new exploration, your new children, if you will, which one do you think you might get? Which one are you the most optimistic on that you might see some early success this year?
I think it's probably Iskit, in that we've really thought this one through for the last few years. We have a target that we think we understand. All the elements are there for a discovery. And I think that's probably the one that can lead to the quickest discovery here, if we are right in terms of that being a gold, copper, porphyry deposit. But with that said, it still is a large claim block that has a lot of other opportunities on it as well. I think the one that can drive value quicker, though, could be Snowstorm, in that if we find something there meaningful, just because who's next door to us, that will drive value immediately. I mean, being next door to the two biggest gold miners on the planet that have a joint venture on projects that are running out of ore soon, that should drive value a lot quicker than might even an Iskit discovery would. And Three Aces is still a year away from our first program, so the other two are a little bit ahead of it right now.
It sounds like a little bit more on the data crunching side to see what they had before you guys go at it hard, right?
Yes.
Well, I mean, they did a great job in terms of de-risking and showing the opportunity here. But I mean, let's face it, a project like Three Aces requires a minimum of $5 million a year on exploration for multiple years. A company that has a market cap like Golden Predator had, and also focusing on another opportunity that could drive value quicker, they really didn't have the financial wherewithal to tackle Three Aces. But what they did there was great work. Matter of fact, our head of exploration has been following that asset for a number of years now. So, we just need to pull everything together, get our arms around it, and put our people to work on it and see where we go with it.
Question here: how about your various projects? You said that you have the money to drill them all, or to explore on all of them. Has there any COVID impact to getting to any of the specific sites or to the areas that you want to do work on?
Absolutely. I mean, clearly the safety of our employees and the population and our contractors, the indigenous people around it, are paramount to us. You know, a few months ago, we didn't know whether we'd actually be able to put our programs in place, and I think we actually publicly disclosed that. Now, though, as we work with the indigenous people, the Tahltan, the Niska, and others, as well as the local communities and the regulators, we now feel comfortable that we can put programs in place safely that doesn't jeopardize the health of our employees or others associated with the project. With that said, though, there are obviously protocols and procedures in place that we will be following that we didn't have last year or any year prior to this. So will it impact it? Yes, but will we get the job done? Yes. Will it cost a little bit more to get the job done? Of course it will. But, you know, that's the world we live in right now.
Okay. And just one more over to Jim. I don't know whether you want to partake in shorter term forecasts, but someone was asking, do you foresee a shorter term pullback after all the excitement in the gold market for the balance of the summer, and then a real resurgence in the fall, or what do you think on a timing basis?
There is a short term risk in the gold market. I think it's more with the gold shares than it is with gold price itself. Yesterday we had, quite a reversal in NASDAQ. The shares were up 2% and they closed down 2%. And gold stocks acted like stocks and actually had a pullback. And, this seems to be the thinking in the market right now, that in these short-term pullbacks in the broader equity market, they affect the gold stocks. Now, the longer run, I don't think that's going to happen. I think it's more about the fact that people who are losing money or fearful in the broader market sell what they can, and they sell gold stocks. I think we saw this also in 2008, and there was 6 weeks there where it was pretty frustrating when gold had turned and the stocks didn't seem to be turning as much, but then they did. So I think there is that possibility in this kind of environment where the concern is deflationary. I think you are still in the majority there, Bruce, with your views. And there is a possibility of that kind of pullback. I think it's a great opportunity. Rudy and I have discussed it. We know some people who feel they've been left behind by our stock price. They'd love to own more. And we'll be calling them, if there is a pullback. In fact, I'll be buying more Seabridge. So, that's how we see it. We've had lots of these little setbacks along the way, but I think we have to recognize where gold and gold stocks are going. We're in a bull market. There's no looking back. There'll be corrections along the way. They're buying opportunities. This is now like the NASDAQ was. It's buy the dips.
And one last one for you, Jim. Will digital currencies impact the gold price? Your thoughts?
No, I don't think so. I think to me, it's remarkable how little traction they've got over the last several years. There was a lot of interest initially, a lot of really excellent technology that was developed, but there just hasn't been the broad use of them in the broader economy that is going to prove attractive. And I think that central banks do not want to lose control of the money spigot, and they are slowly encroaching on the crypto province. So I don't see it. I think there's a lot of confidence right now in gold. Gold has started to perform very well. Yes, you have to store it and all the rest of it, but you look at the forms of digital gold that are now presenting themselves. I think It's the combination of digital technology and actual gold holdings that has the greater promise.
Thank you, Jim. Well, gentlemen, as much fun as this has been, we're now an hour and 10 minutes into the webinar. It really doesn't seem like it. It seems like we just started. I did have somebody actually come on and not make a question, but said, will we get you guys back on in the fall for an update forecast?
Yeah.
And so I promise to do everything in my power from the Red Cloud standpoint to do another one of these in the early fall, and we can update the forecasting. So thank you, Jim. Thank you, Rudy. It was a real pleasure getting a chance to moderate the two of you today. And we look forward to both higher gold prices and lots of success, continued success with Seabridge. So thank you all.
Thank you.
Thanks, Bruce.